Ladies and gentlemen, good day and welcome to the Polycab India Limited Q4 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gandharv Tongia. Thank you, and over to you, sir.
Thank you, operator. Good afternoon, everyone, and thank you for joining us. I hope you all are staying healthy and safe. I am Gandharv Tongia, CFO at Polycab India Limited. On this call, we shall discuss the Q4 FY22 result, which was approved in the board meeting held yesterday. We will be referring to the earnings presentation, financial results, and financial statements which are available on the stock exchanges as well as investor relations page of our website. It can also be downloaded through the link or QR code on slide 9 of earnings presentation. Joining me today from the management team, we have our Chairman and Managing Director, Mr. Inderjay Singhani, and Chintan Jajal, Head Investor Relations, on the conference call. Let me now turn the call over to Inderjay for his comments.
Good afternoon, everyone. Our strong performance in the fiscal year 22 was underpinned by the extraordinary efforts of our team to achieve new milestones even in one of the most uncertain environments. We delivered accelerated business growth, record free cash flow, healthy return on the capital, and market-leading shareholder returns. We champion our renewed purpose of the innovating for a brighter living. Our high power value will guide our thoughts and actions, which will help us create long-term sustainable value for the stakeholder and enrich the lives of everyone connected with Polycab. I now request Gandharv to take you through our earnings presentation.
Thank you, Inderjay. I think overall business environment has remained quite supportive in Q4 despite the sharp inflation. Demand across most segments remained healthy. Macro indicators such as GST collections, e-way bills are at new highs, while other indicators like IIP, Core Industries Index, Consumer Sentiment Index, amongst others, are trending up. Government initiatives and reforms are certainly helping, and even capacity utilization across most private industries is at good levels. Fresh capex announcements are at multi-decade highs. Push towards transitioning to a renewable energy-driven ecosystem globally is like never seen before. All of these are obviously good signs of an initiation of a long capital investment cycle, which bodes well for our business. On the contrary, inflation is now perhaps one major risk to the improving demand environment. While we do not anticipate it to be any more challenging in B2B segment, we will remain watchful of consumer sentiment and how it plays out for B2C categories. One key question raised by many is that copper and aluminum prices have gone so high, won't it affect the demand for wires and cables? Generally, what we have seen is that first, the macros are broadly favorable. Secondly, inflation is quite broad-based. Many industries are seeing stronger balance sheets. For example, given the higher crude oil prices, many projects in oil and gas globally have revived. Similarly, many sectors like metals have benefited. Lastly, but most importantly, quality of wires and cables is paramount for health and safety, and hence our customer segment, which is largely mid or premium, do not want to risk it. Nevertheless, cognizant of these challenges, we remain agile through our portfolio and go-to-market interventions. That gives us confidence to drive industry-leading growth. Before we move on to presentation and financial review, I would again like to highlight that the P&L and segment numbers for current and prior comparable periods are restated due to divestment of Riker Waste in accordance with the applicable Indian accounting standard. All related gains and expenses on divestment are reported under profit from discontinued operations as seen on face of P&L in consolidated financial statement. This, along with few exceptional items of last year, are also presented in slide 10 of this presentation. Moving on to slide 4, for the quarter ended 31st March 2022, our consolidated revenue grew by 35% year-on-year on the back of healthy demand environment despite sharp inflation, coupled with strong execution by our team. It is yet another quarter of highest quarterly sales we have ever recorded. As we have been highlighting earlier, one key focus area remains improving profitability progressively. Even though most of our key inputs remain quite elevated, I'm happy to share that EBITDA margins improved sequentially by about 125 basis points, touching 12%, led by better operating leverage and price hikes. Other expenses and other income as a percentage of sales were lower, while finance costs were broadly stable. A detailed breakup of our other income and finance costs have been provided on slide 13 of our earnings presentation. Our profit before tax at rupees 4.3 billion increased by 17%, while adjusted profit after tax at rupees 3.2 billion increased by 20% year-on-year respectively. On slide 5, for the full year ended 31st March 2022, our revenue grew strongly by 39% year-on-year despite the 2 waves of pandemic and unprecedented inflation. EBITDA was up by 14% with 10.3% margin. Adjusted PAT also grew by 14% year-on-year. It was a year full of challenges, but we achieved several significant milestones. Our overall top line surpassed rupees 120 billion, clocking 17% CAGR in the last 5 years. Exports is inching towards becoming a sustainable rupees 10 billion business. Polycab is the largest exporter of cable and wires in India. FMEG is now a rupees 12 billion franchisee. The business also churned out healthy cash flows with negligible debt levels. Moving on to segment on slide 6, our wires and cables revenue grew by 39% year-on-year despite a relatively healthier base. Demand environment continued to remain encouraging, which led to healthy volume growth. Domestic distribution-driven business continued to see strong traction. However, institutional business was subdued compared to last quarter. Housing wires posted strong growth led by continued momentum in real estate and renovation activities, as well as our demand generation initiatives. A new sub-brand, Etira, was launched in the economy price segment. Trade sentiment in cables was temporarily restrained by significant volatility in aluminum prices, which touched nearly $4,000 per metric ton before correcting sharply. Exports business grew by nearly 100% year-on-year. Excluding a large customer, the growth was slightly better, led by strong demand from sectors like oil and gas, renewables, and infrastructure. Overall, exports business was 7.6% of consolidated revenue in FY22. Our telecom business saw good traction. Towards the year end, Polycab was onboarded by Tamil Nadu Fiber Corporation Limited, or TAPINET, as a master system integrator to implement the BharatNet Phase 2 project and provide end-to-end connectivity with high-speed bandwidth using optical fiber cables in over 3,000 gram panchayats in 75 blocks across 9 districts of the state at a cost of about INR 5 billion under the master service agreement. The revenue of this project will be accrued as per execution timelines over the next few years. Wires and cable segment margin continued to improve sequentially, led by judicious price hikes and improved operating leverage. During the quarter, inflation in our raw material basket as well as price hikes were in mid-single digits. On slide 17, our FMEG business grew 9% year-on-year and 11% on a sequential basis. Overall demand momentum in Q4 was a bit subdued, largely attributable to broader inflation. The business also underwent realignment exercise to improve sales force efficacy and achieve distribution synergy, which temporarily hampered growth. Fans, lights and switchgear business posted healthy growth, while conduit pipes continued the strong momentum. Switches saw a decline due to supply challenges. Given the prolonged challenge in switches, we are now transitioning to in-house manufacturing, which is ongoing and likely to be completed in the current fiscal. The new state-of-the-art facility in Daman will help us improve product availability, drive innovation, and reduce go-to-market time, thereby improving our market presence significantly. Solar business was muted. However, for the full year, it achieved over 50% year-on-year growth. Profitability improved on a sequential basis, but was much lower than last year and our expectations, largely on account of higher advertisement publicity, the staff cost, and input cost pressure. However, we are committed to achieving 12% annualized EBITDA margin in this business by fiscal 26. On slide 8, other segment, which largely comprise of our strategic EPC business, witnessed a 8% year-on-year increase in revenue to rupees 827 million. EBIT stood at rupees 122 million, down 16% on year-on-year basis. On the balance sheet side, our financial position remains quite strong. Net cash position stood at rupees 11 billion, up from rupees 9.6 billion same period last year. Debt to equity ratio is merely 0.01x. Our efforts to optimize working capital is taking shape. We are seeing good optimization of receivables as well as inventory. I would also like to highlight that towards the end of the year, we made a large one-off investment for buying office space in Mumbai. As we move forward in our growth journey, our teams are expanding. However, the current head office building has limited space to accommodate everyone in near future. At the same time, we are also mindful of one other important element, that is having adequate open spaces for cross-functional collaboration and create an inclusive workplace. Hence, we invested about rupees 2 billion to acquire around 55,000 square feet of office space in Mumbai, very close to our existing head office. A part of this cost will be compensated by monetization of existing office in Mahim. We are quite excited to move to our new head office, hopefully by third quarter of the current fiscal. The cost is reflected in the fourth quarter and full year capex number. In the meeting yesterday, board has recommended for the payment of final dividend of rupees 14 per equity share for the year ended 31st March 22, subject to the approval of the shareholders. Our dividend payout ratio on external profit will sequentially improve further to about 23% in FY22. Moving on to exciting stuff, Project LEAP, our flagship transformation project. Just to recap for everyone, Project LEAP is a multi-year program that includes a range of strategic themes and initiatives focused on growth, profitability, and long-term capability building for the organization across B2B and B2C businesses, with a goal of achieving greater than rupees 200 billion or 20,000 crore sales by fiscal 26. We have partnered with global management consulting firm BCG, who will help us drive this transformation. It's been 1 year in this journey, and we have made significant strides towards our vision. In the first year, we primarily worked on 4 areas, that is, setup of right organization enablers, customer centricity, go-to-market, and product portfolio optimization. Delving deeper in the first, that is, setup of right organization enablers. Within this, the major initiative was setting up the right organization structure and fill critical capability gaps across the departments like manufacturing, procurement, supply chain, digital, and IT, and across the businesses including B2B, fans, lights, and retail wire. Over 90% of talent acquisition for critical roles was completed in fiscal 22, while the balance will be done in the coming quarters. Performance measures, rewards, and recognition we aligned to the growth strategy and cascaded through all levels of teams. New transformation management office was set up to strengthen governance and, most importantly, monitor the implementation of various initiatives, because we believe we have an ambitious vision for our organization. We also have the enablers, so execution has to be sublime. Second area is customer centricity. During the past year, we redesigned the operating model of B2B businesses. The new model was implemented in pilot state and showed tremendous opportunity for growth. Accordingly, we took a bold structural move to merge heavy-duty and light-duty cable verticals in order to unlock latent value through cross-selling opportunities and operational efficiencies. Given the significant distribution and geographical overlap, this initiative will materially improve customer servicing, as most of their B2B wires and cable requirements will be addressed by a single point of contact. Combined portfolio selling will drive faster business growth. Optimization of team structure and joint back office operation will also enable faster rollout of GTM initiatives while establishing a leaner cost base. Marketing and influencer management platforms will be streamlined to increase efficacy. The new structure also includes key account management or CAM to enable selling of full product portfolio and bring in more customer focus. We designed and piloted unique structured influence management to support our B2B businesses. Third area is GTM. I have talked about this earlier. As you may be aware, we put in lot of efforts to build presence in semi-urban and rural India. Post successful pilot projects to select rural markets, we took several initiatives to build infrastructure, portfolio, and team to leverage the immense demand potential of semi-urban and rural India. We created a new business vertical called Emerging India, focusing on building presence in towns with up to 2 lakh population. Distribution architecture was designed post-detailed mapping and evaluation of these geographies. Product portfolio is being calibrated to address specific needs of customers while offering innovative products at economical price points. Another area where we've really worked hard on is building presence in alternate channels like e-commerce, modern trade, canteen department stores. Currently, over 600 Polycab products are available on all leading e-commerce portals like Amazon, Flipkart, JioMart, and Moglix. We believe these 2 new sales channel verticals will act as additional levers of growth for our B2C businesses. Core distribution expansion was driven by rigorous execution using digital tools and structured playbook. We fast-tracked expansion, clocking a nearly 2x increase in direct town coverage. Our authorized dealers and distributors increased from over 4,100 last year to over 4,600 now. Retail outlet reach increased by nearly 25% over last year to about 205,000 outlets now. We also successfully piloted end-to-end digitalization of front-end sales. It is currently being rolled out in phased manner. Lastly, we are trying to create a winning portfolio of products which are innovative and resonate with consumer needs. Towards the end of FY22, we launched new sub-brand Etira, which will play a pivotal role in economy price segments as well as enable our expansion into emerging India clusters. Currently, we have launched Etira Housing Wire, which has seen strong response. We will extend this brand to other categories progressively. Overall, we have built a robust portfolio roadmap for next 3 to 4 years across large businesses. This will ensure we are present in segments which are growing faster and are margin accretive. NPD or New Product Development Councils have been set up across businesses for structured review and governance of innovation initiatives. We also saw healthy progress in premiumization journey. For example, premium products now contribute 16% to overall FMEG business, which was just 7% last year. So that was broadly on FY22. Going ahead, we have chalked out some key focus areas for next year. One is improving customer centricity through enhancing visibility and control of secondary sales by significantly improving our understanding of end users and influencers. Secondly, we will aim tirelessly on executing the NPD roadmap to drive market share gains as well as premiumization. Third, again, go to market where we aim to digitalize the entire distribution ecosystem. And lastly, emphasize on governance where we will monitor progress towards clearly defined growth and profitability drivers for all building blocks. So that's about it on LEAP. We will continue to share periodic updates and we are excited to see how the coming year pans out. While there could be challenges like inflation, pandemic, amongst others, we are confident of our strategy and which will enable us to grow this proportionately. Thank you for patiently hearing us out. With that, I hand over the call to operator for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Naval Seth from Emkay Global. Please go ahead.
Yeah, thank you and congratulations, Gandhar, for stellar performance. Few questions first. Can you outline what was the value and volume mix for 4Q and FY22 for cable and wires and FMEG?
Thanks, Naval. Thanks a lot for your compliment. If I talk about cable and wire, we can broadly say that around 25% of the total growth can be attributed to volume and balance for value. And in FMEG, it will vary from product category to product category, but it would have similar trend there as well.
Okay. Second, on your Project Leap, as you stated that in terms of your dealer distributor expansion of 12% and retail outlet by 24-25%. Now I see that this the major increase has come in 4Q because your corporate presentation of January suggests the same number of 4,100 and 1,65,000, and now it has expanded. And during the same period, your market share has also improved by 200 basis points. So now, as you have outlined your strategy very clearly, can you also share what is the aspirational market share you want to reach with the kind of aggression you are outlining in Project Leap?
Sure. So the first one on the data points, these data points generally we revise on annual basis. So, the presentation which you are referring to December probably had March data point, and we'll continue to revise these data points on annual basis. As far as aspiration is concerned, Naval, you know our history. By folded into this business almost 5 decades back, we were no one in cable industry. We got to number 1 position in cable. Wires we started in 1996, we are number 1. We enjoy almost 24% of market share of organized market. And as we go along, we want to outpace the industry and our peers and grow in disproportionate manner. As part of Project Leap, broadly we are targeting 20,000 crore rupees of top line over the period of 5 years. Last year in FY21, we exited close to 9,000 crore rupees of top line. In the first year of Project Leap, we have already crossed 12,000 crore rupees. So it seems that we would be able to achieve 20,000 crore rupees of top line under Project Leap.
So is it fair to assume a 200 basis point kind of a number, market share improvement year on year, at least in this Project Leap period?
I can certainly talk about the past. This year, FY22, we have achieved, we would have gained at least 200 basis point of additional market share. Our aspiration on Leap is to enjoy our leadership position and further enhance it. And even for FMEG, the aspiration is similar, that slowly and gradually we should get into top 5 market players, then to top 3, and eventually in few select product categories move upward even from top 3 to further north.
Sure. Last 2 things. One is clarification that volume value mix you stated was for FY22. Is that correct?
Yes.
Okay. And lastly, can you provide some color on capex spends for FY23?
So historically, we have incurred around 300-350 crore rupees every year. Exception was last year where we incurred 300 crore rupees for regular capex and 200 crore rupees for a new office, which I alluded to in the opening remarks. As we go along, I think a number between 300 and 350 crore rupees is a sustainable capex number. Having said that, in year 2 of Project Leap, we would explore what we need to do differently. For example, getting into additional product categories or further building on M&A initiatives. So excluding these 2 because they are still under study stage, a number of 300 to 350 crore rupees is what we should factor in for FY23 as far as capex is concerned.
Sure. Thank you and all the best. I'll come back in the queue.
Thank you, Naval.
Thank you. The next question is from the line of Ravi Swaminathan from Spark Capital Advisors Limited. Please go ahead.
Hi, sir. Good afternoon. Congrats on a very good set of numbers. If you can give a breakup of the wires and cables business in terms of ratio of how much is cables and how much is wires, if you can give that breakup, it would be great.
Sure. Thanks, Ravi, for your compliment. Cable and wire broadly, I would believe that we are around in the early 50s as far as cable is concerned, and the balance is wires. In total basis, if I give you a breakup of entire 12,000 crore rupees of top line, around 60% would be 58-60% would be B2B, and around 40%, give and take 1 or 2 percentage point, would be B2C.
40% would be B2C. Okay. And majority of the 40% would be wires, sir?
Yeah. So we around 10% of our top line is FMEG, which is fan, light, doom, and all those products, and balance is wires.
Wires. Okay. And any difference in strategy between the growth in cables and wires? I mean, in the sense that do we aim for a higher growth in wires vis-a-vis cables, or vice versa? Is there any view on that? Because wires, I believe, carry better margins than cables. So, just what are your views?
Absolutely. Your understanding is absolutely correct. Wires are more profitable because of B2C product, whereas traditional cables are B2B, where the profit margins are comparatively lesser than wires. As I was mentioning to Naval a while back, objective is to get to number 1 position in all the product categories, and then significantly expand our presence there, enhance our positioning. Though wires is more profitable, I don't think the strategy is that we would like to just concentrate on wires. We are looking for more holistic picture, wherein we want to go for growth across all the product categories where we are present. Enderby believes that if you are in a product category, you should be the number 1. If you don't want to be number 1, you should not be there in the product category, and that is the guiding principle which we are trying to follow across all the business segments where we operate.
Got it, sir. And the kind of volume growth that we would envisage over the next 1-2 years in the wires and cable segment, what would be the target that we will be having? Any sense on that?
I can give you a directional thought process, won't be able to give you a number. You can safely assume that we are going to grow significantly higher than the industry growth.
Got it, sir. And my final question is with respect to the FMEG business. Can you give the revenue breakup for the 1,250 crores in terms of fans, lighting, pumps, etc.?
Yeah, absolutely. So fan would be around 1/3 of our top line of FMEG, and switch and switchgear would be around 15%. Light and loom would be around 15%, and then there would be other small business categories.
Got it, sir. Thank you.
Thank you. The next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity and congratulations on a great set of numbers, sir. So my first question is regarding the price hikes. Would you be able to elaborate what is the quantum of price hikes that we have seen in FY22 and particularly in Q4, and also any price hikes that we have taken from 1st April onwards?
Sure. Thanks, Sonali, for your compliment. If we talk about fourth quarter, at the raw material product basket level, we witnessed inflation in mid-single digit, and more or less the price hikes we have taken is in similar range, and that is where you can see the contribution margin of March quarter is comparable with December quarter. So we have been able to pass almost all the input cost increases to our end customer in the current quarter.
Right. So and cumulative FY22 and from 1st of April.
Yeah. So, from the next year, the business model. The business model is we try to recalibrate our prices on a monthly basis after factoring 2 data points. One is change in the commodity prices. Second is change in USD INR exchange rate. So we'll continue to do that. The intent is to maintain traditional cable and wire margins, which used to be between 11 to 13%. So our intention is to maintain that range.
Got it, sir. So my second question is regarding your B2B and B2C business. You mentioned that 60% is B2B right now. So what could be the number about 5 years back?
My sense is that number would be around 70%, or around 70% of B2B and 30% of B2C, around 5-7 years back.
Got it, sir. So, and on an industry basis, what is the kind of channel inventories that we are looking at? Are they at optimum levels or lower? My question is, from the point of view of volatile copper prices.
If I talk about FY22, I think these were at acceptable level, but since 1st of April, we have witnessed a fair amount of correction in both as well as copper, as well as in aluminum inventory levels, copper and aluminum price levels. In such a situation, what we have seen is generally dealers and distributors would like to reduce the inventory levels so that they don't lose on the margins. If the prices are on upward trajectory, that is where they build higher inventory levels. So a small amount of correction is possible in channel inventory, but I don't expect that would be very material.
Got it, sir. And what about FMEG inventory?
I think it is at acceptable levels.
Okay, normal levels. Then lastly, any guidance you would like to share for the near term in terms of either the revenue or the margins, please?
Sure. As I was mentioning to Ravi as well as Naval, that as part of Project 3, we want to touch 20,000 crore rupees of top line by fiscal 26. And we embarked on this program last year. In FY21, we did 9,000 crore rupees of top line rounded off. This year, we have done 12,000 crore rupees. So directionally, we are on set to achieve 20,000 crore rupees of top line as far as our performance on top line is concerned. On the margins, on cable and wire, we'll continue to hover between 11% to 13%, and we would like to improvise as we go along than the current levels, which is hovering around 12%. On FMEG, we aspire to get to 12% by FY26.
Got it, sir. Very helpful. Thank you and all the best.
Thank you very much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your question to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, good afternoon and congratulations for good results. My top 2 questions here. First is on the FMEG portfolio. As you have mentioned, the business has been looking at multi-brand strategy positioning in the premium, mass premium, and also launching the ERTIA for the economy segment. So as a company in the next 18 months, given that there's an inflationary headwind, could be risk of downtrading, how should one look at where would be the incremental focus be in the near term? And are you seeing any potential headwinds in terms of demand softness because of inflationary impact or near-term softness in the real estate market to that extent? That's the first question.
Sure. Great question, Renu. I have Chintan also on the call, who is our head investor relations. So I'll request him to participate in the call. So Chintan will take this one.
Hey, hi, Renu. So I think our strategy in FMEG is really to cover all the price points. So what we aim to do is, straddle across all the price pyramid, across price spectrums. So if you remember, our portfolio is largely focused more on the mid-premium space. And eventually, over the last few years, what we've tried to do is increase the share of premium products. So, say, for example, in various categories, if I pick up fans, for example, the share of premium fans is increasing. Even in lights, the share of, say, premium panels, etc., is increasing. Overall, in consumer business, I think the premiumization percentage has improved. Now, what we are trying to do is, we are even trying to get into the economy price points or maybe sub-economy price points. So we are working on our entire brand architecture just to ensure that, there's minimal cannibalization and, we spread our brand presence through effective brand communication. So we recently launched a new sub-brand ERTIA, which will play at these lower price points. Currently, we've launched it in wires. We also aim to extend it throughout our portfolio. And I think this will really help us develop our presence and resonate better with consumer needs and wants. And especially, when we are trying to get into say, alternate channels as well as geographies like semi-urban, rural. I think here you need the right product portfolio to really drive that penetration, and that's where this brand as well as all of our portfolio initiatives will help.
Sure. My second question is on the cables part of the business, where the company has been consciously trying to come up with specialized cables and applications to improve the portfolio. So if you can share some updates on this side, and on the average 300 to 350 crores capex which you've mentioned, how should we look at the incremental spending across various sub-segments and categories in which the company is present?
Sure. So on the first one, we are perhaps the only company in the entire country or probably in the continent which can supply all types of cables and wires. We have only one space where we don't have adequate presence, which is EHV, and we are trying internally to figure that out, how we can offer products there. In this year, we have been able to get 2 new spaces, for example, defense, automobile, railways, and all of these product categories are niche with good margins and require fair amount of product innovation. On the capex, out of around 300-350 crore rupees, broadly 2/3 will go to cable and wire and 1/3 for FMEG. Within that 2/3, most of it will go for setting up new facilities to meet the export requirements, as well as for the product categories where the utilization is fairly high. A part of it will go for maintenance and a balance for backward integration. On FMEG, we will invest in product categories where we don't have enough manufacturing, for example, switches, and we'll set up facilities where the utilizations are fairly high.
Got it. Thank you, and get back in with more questions. Thank you.
Sure. Thank you very much.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Hi, thank you, and congratulations on the performance given the challenges. Just 3 quick questions, Gandharv. One is on the cash usage. I think I'm sure that the senior leadership is looking at that number, and the cash flows are increasing year on year. You already have 1,100 crores. I'm thinking you'll have another 8 to 10 billion rupees next year as well, given what growth we're talking about. You alluded that you'll look at new categories to get into or some kind of M&A. Could you throw some more color on this? That's the first question. Secondly, anything on the FMEG EBIT margins is still tracking pretty low for the year as well as for the quarter. Anything you'd like to state for fiscal 23? And third is on the significant reduction I can see on inventory, debtors and creditors across. Though the net working capital is across the same YOY. What is really happening here? I'm sure BCG is working very hard here, and this was a very high priority area for us. Good right there as well. Thank you so much.
So on M&A, when we embarked on this project LEAP, we felt that we have to do several things. But what we decided is we'll split the entire project into 24 work streams. And then we picked up few work streams as year 1 priority, then few work streams for the year 2 priority, and so on. M&A and evaluation of adjacent product categories, we decided that we will take those up in the second year. And as we embark on the second year of project, I expect by September quarter, we should be able to give you additional color what we should be doing. But you are absolutely right that business Touchwood is generating fair amount of cash, and it's better to use that cash to meet the growth ambitions of the company, and by that means improve the shareholder settlement. On FMEG margins, this quarter, of course, there was some pressure of inflation, but at the same time, we got into this realignment because what got us to 1,000 crore rupees will not necessarily will take us to just to say a number, say 5,000 crore rupees, right? We have to change the strategy, and this is what we did. We ensured that we have right leaders in place. We have hired, for example, fence leaders from another peer company, Tapas. We have hired another veteran from Panasonic who was superannuated as MD of Panasonic to lead our FMEG or B2C business. So we have done fair amount of investment both on the process and enabler side as well as on the capability side, and which is getting reflected in this year's margin. But as I mentioned a while back, we are confident on 12% EBIT margin in FMEG business by fiscal 26, and this year we should be able to further improve on the existing margin levels. Third is on working capital. Your observation is absolutely correct. It is a focus area and will remain a focus area. If you split the working capital in two broad categories, one is receivables and second is inventories. On the receivables, we have been able to further improve our channel financing penetration. Cable and wire, give and take 2 percentage points, we will be around 70% of channel financing. And FMEG, we have almost touched 50%, and which is helping us in reducing our receivable number of days. And these facilities are without any recourse. On the inventories, we have been able to optimize. Now, the game is to balance the availability so that you are able to meet the requirement of the customer and optimize the inventory. We will continue to work on this, and that is where, of course, BCG is helping, but the leaders we have hired recently, they are also spearheading these initiatives. To give you an example, we hired someone as head of logistics almost 8 months back, Vipul Agrawal from another peer company, and he is doing a fantastic job on optimizing the inventory levels and improving the overall delivery time to the end customer.
So this is the base, right? And that continues going forward, right?
On channel financing,
on net working capital. Yeah.
Sorry, I missed that. May I request you to please just repeat?
On net working capital, is this the base going forward? I mean, you'll just improve from here, right?
Yes, absolutely.
Okay, and just lastly, you answered the question partly saying fiscal 23 capex, where do you want to spend? Could you help me understand where do you spend the just broad areas where do you spend?
Sure. Let's split this into two parts. Around 2/3 will go for our regular cable and wire business and 1/3 for FMEG. On 2/3 part of it, most of it will go for building capabilities and capacities for exports market and for the product categories where our utilization are very high and we need to put in additional facilities. That's one portion of that 2/3. The second one is on backward integration and third is maintenance capex. On the remaining 1/3 in FMEG, most of it will go for additional capacities which we need to build. For example, for switches, we don't have in-house factory, so we will set up that. There are a few product categories where our utilization is fairly high. We'll have to have spend capacities there, and a part of it will also go for preventive capex.
Thank you so much. Best wishes for fiscal 23. Thanks.
Thank you so much.
Thank you. The next question is from the line of Atul Tiwari from Citi. Please go ahead.
Yes, thanks a lot and congrats on a very good set of numbers. So just one question. How much would be the broad price hike taken over, say, past 12 months across cable and wires and FMEG? And as a result of this price hike, are you seeing any sign of either demand slowdown or downtrading in any part of your portfolio?
On cable and wire, in the fourth quarter, we would have taken a price hike of mid-single digit, and the inflation was also in the single range. Progressively, we have been able to improve our EBITDA margin. If you remember, in the first half, we faced a bit of challenge on maintaining contribution as well as EBITDA margin, but after that, things have improved. Third quarter was completely better than the first half, and the fourth quarter was better than the third quarter. On FMEG also it's mixed bag. There was a bit of pressure on contribution margin in the first half of the year, but after that we have been able to take price hikes there as well.
So any sign of demand slowdown or downtrending by customers in any of the portfolio as of now?
No. There's some bit of inflationary challenges in a few of the product categories, but it is not broad-based. In fact, if you are available, if your product is meeting the specification and requirements of the customer, practically there's no challenge on demand.
Okay, great. Good to know. Thanks a lot.
Thanks a lot.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. My first question was, you in one of the answers you mentioned that 25% is the price increase and about balance is the volume increase. in both FMEG as well as cables and wires business. Have I understood it right?
Partially right, it's other way around.
So you're saying 25% is the volume growth and 15% is the price increase in both the segments.
Out of the total increase, 25% is because of volume and the balance 75% is because of value.
Okay. Number two is it possible, like you mentioned in terms of volume for FY22, and I presume FY21 was kind of a low base. If we were to look at in terms of volume CAGR for last 5 years, would it be possible to put a number? Would that be mid-single digit, high single digit, mid-teens, any number, ballpark number?
It would be slightly incorrect for me to give that number to you. I don't have that handy, but I can give you, a color on this. My sense is our number would be significantly better than the industry number.
Of course.
Whatever cut last 3 years, last 5 years.
Yes, that part I completely agree. What I just wanted to check is the aggregate growth, volume growth. And the second question I had in mind is, in terms of the pricing, for cables and wires specifically, in terms of pricing our product, is it the margin percentage margin or it is rupees per unit, maybe per meter, per kg, anything? If you can give some color.
It's percentage margin.
It's a percentage margin. Okay. So, which brings me to the next question. If copper prices and aluminum prices were to normalize to earlier averages, how would that impact in terms of the volume and the margin? This is a hypothetical question, but just color your perspective on the same would help.
So as I mentioned, it's a percentage margin. So irrespective of the fact whether top line goes up or down because of increase or decrease in input cost, we would be able to maintain the margin. Historically, in cable and wire, we have hovered between 11% to 13%, and we should be able to maintain that.
Got it. This is very helpful. Thank you so much, and all the best.
Thank you very much.
Thank you. The next question is from the line of Chetan Gindodia from AlfAccurate. Please go ahead.
Hi, Gandharv, and congratulations for a great set of numbers. Just two questions. Firstly, you said that the volume growth is 25% of the growth of this year. So 40% was the revenue growth for wires and cables. So kind of implies 10% volume growth. This seems kind of underwhelming considering the major building material players, big players are seeing kind of 20% volume growth for this year, given the real estate buoyancy. So, just wanted to understand why has been the volume growth low and any reason for this, and do you expect this to improve going from here?
So, the volume growth cannot be directly linked with the real estate. Our products are introduced at the different phases of the construction, and that is where it's not apple-to-apple comparison. As far as future is concerned, as I mentioned a while back to another participant, that we are inching towards 20,000 crore rupees of top line by FY26, and we will continue to outpace the industry growth.
Okay. And just lastly, wanted to understand on the payable days. So whatever gains we have achieved from reduction in inventory days and receivable days, we have kind of given that away by decline in payable days. So what has really led to the decline in payable days? Because because of this, our ROC is not improving. So just wanted to understand what has led to the movement in payable days.
Yeah, I think a great observation. We import copper. Copper is the biggest or most significant raw material if we talk about our cable and wire business, and we import copper from overseas market. In the last year, in the fiscal 22, during the course of the year, we realized that because of logistic challenges, we should have alternate options available in the form of domestic supply. And in the domestic market, generally speaking, it is on cash and carry basis. So you get supplies by making advance payments, as against in the import arena where you get LCs, which could range between 90 days to 180 days. And which is what we have done in the current year, which has impacted the payables days. Having said that, I don't think that will continue in future in the similar proportion. Of course, we will continue to have some supplies from domestic market, but in the form of cash versus LC, we should be able to get LC option from both the suppliers, domestic as well as an import, and we should be able to go back to our regular payable days once we get to that type of arrangement, both with the international suppliers as well as the domestic suppliers.
Okay, got it, Gandharv. And all the best to your team.
Thank you very much.
Thank you. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, Gandharv. Thank you for taking my question. My first question is on the FMEG. When we look at your last 5 to 6 quarters, pretty much stuck, in the top line of 340 to 350 crores on an average. When I look at your annualized number, being industry saw last year a huge pent up, our growth is just about 21%, and I'm assuming there must not be any, or let's say a very less volume growth in that, to be honest. Though you started saying that volume growth is in the double digit even in FMCG, so that's not adding up given what other consumer companies are saying. Minimum category price hike is in the range of 15 to 16% on an annualized basis. So what's going really wrong there in FMEG? Are the products what we have launched are not able to scale up? If you can throw some light on that, because I'm not comparing you with the other players. You're so small in the industry because your growth should look way higher. And that's also not happening even if you look at Q4 numbers. So that's my first question, if you could throw some light on that.
Yeah, no, absolutely right. Your observation is correct. Our business underwent realignment exercise to improve sales force efficacy as well as to achieve distribution synergies, which has hampered temporarily our growth. We have also identified the need to change the overall operation model because what got us to 1,000 crore rupees will not necessarily take us to say just throwing a number to 5,000 crore. And we also had fair amount of change at the leadership level in our B2C business. But at the same time, I must acknowledge this is momentary. From the next quarter onwards and later in the current year, we should be able to bounce back. If I were to give additional color, for example, because of switches, we had some supply side issues because of which, though we have taken the corrective action in the form of setting up a new facility, it has impacted our top line and bottom line performance for the year gone by. So it's a mix of everyone. We have, our action plan in place. A part of it has already been implemented in the form of new leadership, in the form of product innovation. To give an example, we launched BLDC fan, which can be operated with the help of remote. Chintan a while back talked about Atira brand, which has been launched. So the corrective actions are being taken. We should be able to bounce back. And as I mentioned a while back, we are confident to achieve 20,000 crore rupees of top line, including for FMEG and retail, and a 12% EBITDA margin by fiscal 26.
And secondly, just on cable and wire, though you talked about, in the starting, I think everyone got confused that there is a 25% volume growth, but I think you clarified saying that it's a 10% volume growth, 25% of the overall revenue is the volume growth. So the 10% volume growth, can you attribute some segments where it has come from? Because despite, so much commentaries being spoken about that, there is a phenomenal growth across industry, capacity utilization of private industries are so high, the volume growth is still about 10%. So it will be helpful to understand, where actually the growth is coming from and how you're looking this volume growth, at least a 10% growth even for FY23. Is that the base number you're working with on the volume side? That's my last question. Thank you.
Yeah. So, to give you an answer on this 10% type growth or 25% of total increase in top line, it is broad-based, product by product. If I were to give you a flavor of cable and wire, it would range between 35% to 40-45% across all geographies. For example, in the case of wires, we witnessed a growth of almost 60% in southern market. And in the case of flexibles or light-duty cables, we registered a growth of almost 60% in other market. But to give a broad big picture across product categories and regions, as far as future is concerned, I would probably take you back to our ambition of 20,000 crore rupees of top line by fiscal 26, and we are committed to maintain the momentum and improve further as we go along.
Thank you, Gandharv. Thanks a lot.
Thank you so much.
Thank you. The next question is from the line of Aniruddha Joshi from ICICI Securities.
Yeah. Thanks for the opportunity. So on the Etira brand, basically if we see most of the durable companies, they operate with one brand only, considering limited surplus for brand building activities. And all the variants, be it economy, mid price, or even the premium, are introduced with the same brand itself. So why we have gone ahead with basically a new brand Etira itself at the low end of the market? So and also, will Polycab and Etira brands will both operate in the same market? Then there is a risk of cannibalization, or will they operate in completely different geographies? So what is the plan on Etira brand? Yeah, that is the question.
Brands who conduct the brand study for us. We are also working with Ogilvy on our marketing side of it. They are the agencies for marketing for us. And when we were going through the product portfolio optimization exercise, we realized that in few of the product segments, we don't have products available at the right price point or at all the price points. That is when we thought of Etira. Etira is slightly different product with slightly different product specification to meet the requirements of the customers who are cost conscious without compromising, of course, on quality and with a focus on different geographies. So Etira would probably cater the requirements of emerging India, where all government-led supplies which are required to be met by the dealers and distributors, where not necessarily they want to spend more money, and at the same time they don't have higher expectation in terms of quality. So, for example, on the green wires, we have better specification, but it's slightly more costlier, which can be said as like a premium variant of the regular retail wires, whereas Etira is on the economy range or just sub-economy range product.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Dhananjay Tongia for closing comments.
Okay. Thank you everyone for taking out time and attending this call. We would be happy to attend your questions. You can always reach out to me or Chintan, or you can write to us at investorrelations@polycab.com. Thank you for your confidence in us. Take care. Bye-bye.
Thank you. On behalf of Polycab India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.